Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Our guest today is James Turk. He is the founder of Gold Money. Thanks for joining us, sir.
Thanks. It's great to be here.
Well, it's a pleasure having you back on. James, the big news is out. Our money machine friend Powell is back as Fed chair, and gold and silver dropped quite a bit. Do you see a rebound?
It's quite ironic, isn't it, that here we have the Fed chairman who's created the biggest amount of balance sheet increase to the Federal Reserve. We've got inflation running at 6%, and he's being brought in because he's supposedly going to keep inflation controlled, and gold and silver dropped today because of the announcement. It's a little bit ironic.
Yeah, it's pretty crazy.
You know, that raises a really good point. Here, I'm going to share another one. Let's review the numbers under Powell. And I happened to tweet this I saw this picture this morning and tweeted it myself. You know, Jerome Powell has been, in his 4 years, the Fed's balance sheet's almost doubled. Inflation rates almost tripled. These are nice trends. I mean, what do you think? Are we going to see another double, maybe 17 trillion by 2026? And maybe a triple here to 18% by 2026? Is the trend your friend here?
Yeah, one of the advantages of being older is you've got a lot of experience. And I lived through the 1970s inflation from the beginning through the end. And the way the inflation was brought to its conclusion by Paul Volcker is you just kept raising interest rates higher and higher and higher. So Powell is in the same situation that Volcker was. He has two alternatives. He can fight inflation and save the dollar, or he can let inflation continue to worsen and not save the dollar. And I think he's not going to save the dollar. And ultimately, inflation is going to get much, much worse, which is very worrying because when you have severe inflation, it's very disruptive to society.
It's a lot of people are assuming right now and pricing in that they are going to raise inflation, raise rates to cut. There seems to be an expectation in the market right now that they are going to fight inflation. They're going to continue tapering, and then next year they're going to raise rates at least twice. So you're saying probably not, or they're not even going to finish the taper, or they're not going to raise rates, or where do you think it comes to a halt where the market realizes that's not going to happen?
All the market has to do is complete its sums and just look at where we are now versus where Volcker was. Remember back in the 70s, the US was the largest creditor nation in the world. We're the largest debtor nation in the universe now. And if you raise interest rates, consider what it's going to do to the federal government's finances. The federal government makes earns in revenue about $3.6 trillion a year. If you raise interest rates, even 1% on a 30 trillion of debt, you're raising 300 billion a year. That's 10% of the federal government's revenue. The federal government's not going to cut back in other areas to pay that interest expense, which means that the deficit is going to get bigger and the debt's going to get even bigger. And that's really the cause of hyperinflation. A government spends so much money that eventually the Federal Reserve or the central bank of the country where the hyperinflation occurs, just keeps printing money if it's cash currency, or creates bookkeeping entries if it's deposit currency, which is basically what's happening with the Federal Reserve. They just add zeros to the federal government's checking account.
Where should Fed funds be right now if they were going to fight inflation?
A lot higher than they are at the moment. And the inflation rate is 6%. You have to have real interest rates. In other words, an interest rate above the inflation rate in order to show the market that you're sincere in fighting inflation. During the height of the Volcker interest rate movements, the real interest rate got to be about 6.5% above the inflation rate. In other words, you had let's say a 16% rate on federal government debt when the inflation rate was 10%. So we're way behind the curve. We've got negative interest rates of 6%, let alone real interest rates of 6%. So that means there's going to be more inflation and more debasement of the dollar. And remember, with 6% inflation, $100 today in 1 year's time is only going to have the purchasing power of $94. And that's why society gets disrupted by inflation, let alone hyperinflation.
Well, the deflationist types, they're out there arguing right now that it's just supply chain disruptions, and none of this has anything to do with Fed policy. And Fed policy is actually deflationary, it's not inflationary. I mean, what's the answer? I don't agree with them, but what's the answer to that argument?
Well, obviously there have been some disruptions because of COVID and the supply chains. But if you go back and look at inflations, worldwide, what happens in a country, people exit the currency and buy things. And that's what causes the shortages and what otherwise are called supply disruptions. You know that everything's going to be more expensive in 1 month, 3 months, 6 months. So you're going to buy stuff today rather than wait 6 months and be able to get less for your money. That's a sign that we have inflation. It's being muddled by the fact that the central bank is saying that the inflation is being caused by supply disruptions rather than their own money printing. But we have to go back to basics. Milton Friedman said that inflation is always and everywhere a monetary phenomenon. If the central bank creates too much currency, you're going to have inflation, and that's exactly what's happening today.
But some of the deflation argument is the Fed's not doing that. The Fed's creating reserves. They're not printing money. I mean, and the reserves just stay, in the commercial banks. Reserves don't leak outside of the system into real people's hands. And I think that's a bunch of, whatever. But that's the argument they're making that I'm having to deal with and debate people on Twitter about. So I need some new ammo. What do I tell these people?
Look at the M2 money supply, which just recently grew at 25% per annum. Mm-hmm. During the 1970s, the money supply never grew, I think, more than on an annual basis, more than 8 or 10%. Here we're twice, 3 times what it was growing in the 1970s. And you still have the Federal Reserve printing $110, $120 billion a month of new currency. So money supply shows you why inflation is going up. It's increasing the quantity of currency. And the more currency you have, with the same amount of goods and services that are operating, there you go. The same amount of goods and services, the goods and services become more expensive relative to the currency. Put it this way. Remember several years ago, Ben Bernanke was talking about a helicopter drop. Mm-hmm. That if we had inflation, the Fed would create currency and drop it from a helicopter. Well, you have so many goods and services in the world. If the quantity of currency doubles overnight because of a helicopter drop, you don't become wealthier. You now have the same goods and services with twice the amount of currency chasing those goods and services. That's what causes inflation. It's money printing. Mm-hmm. So when you look at this money supply number that you've just put up, you can see why inflation is starting to surge. And this doesn't end overnight. This is starting to grow. I remember in the early 1970s, it just kept growing and growing and growing over 9 years until Volcker finally came in and brought an end to it. But I don't see any indication that this current administration or Federal Reserve is doing anything to end the current rate of inflation.
Yeah, we just endorsed a continuation of the policy, obviously, with the Paul, what's his name? Jerome Powell is definitely going to be reapproved. Lael Brainerd is now vice chair, the MMT princess, as we call her. So it's more of the same. Party on, right? 4 more years.
Party on. Protect your purchasing power by buying precious metals.
And
this is another thing that just sort of gets my goat, because everybody's saying, well, why aren't gold and silver going higher? Well, they are going higher. They're just not going as high as they should be going because of obvious intervention by the central planners who don't want the canary in the coal mine to signal that inflation is going to get worse. But eventually the metals will go higher as inflation does get worse, because the Federal Reserve cannot change fundamentals. What the Federal Reserve thinks is that they can make the market bend to its will. But if you look at history, it's the market that makes central banks bend to their will. That was true with the London gold pool back in the 1960s, when the market eventually forced the central bank cartel called the London gold pool to throw in the towel and let the precious metals rise to free market levels. It was also true in 1991 when George Soros and his pals broke the Bank of England. The Bank of England thought that they could break the market, but in fact, the market broke the Bank of England. It's going to be the same thing that happens this time around as well. The market will break the Federal Reserve. It's just a question for when it's going to happen. And when it happens, gold and silver will fly. That's why you should continue to accumulate gold and silver, because it will preserve your purchasing power in the short term. And in the long term, it'll enable you to get across the valley and have your wealth intact.
Just so the audience knows, it's Monday while we're sitting here talking with James Turk, and I'm going to show the chart real quick for how gold is responding. Gold's down 32 bucks today, right now, as we sit here around the 1 o'clock hour recording. And why do you think the market's responding this way? The precious metals market is responding this way to Jerome Powell being renominated.
Well, for 20 years, I've been writing about how central banks don't want the gold price to rise, and they do various things to keep it from rising.
Mm-hmm.
Back in the early part of the century, they had what was called a managed retreat. They would debase the currency, but they would allow the gold price to rise a little bit, and it rose 10 years in a row. Since 2010 or so, 2011, when gold went to record highs back then, they've taken a different approach. It's much more forceful in trying to keep the gold price from rising. And recently, we just had 7 days in a row when gold was rising after they announced the CPI number of over 6%. So gold did get a little bit overbought, but that created an opportunity for anybody who is anti-gold to take a short position and let an overbought market come back to a more normal level. And during that period of time, COMEX open interest rose by over 100,000 contracts. That's approximately $18 billion of shorts put on when gold went up from those 7 days in a row. Now, $18 billion sounds like a lot, but it's not when it's compared to the $120 billion that the Federal Reserve is pumping every month. So it's very easy to control the paper markets in gold and silver when you have unlimited resources available behind you. But again, eventually,
you mean like my gold vault back there?
Yeah, exactly. Yeah, it's very attractive. Eventually the market will break the Federal Reserve. It's just a question of when it's going to happen. And in the meantime, you just continue accumulating, or as you guys like to say, keep stacking.
How crazy is it, James? You were just saying that gold was overbought at that price when you're looking at Bitcoin and it's $50,000-$60,000, and we're talking about gold being overbought at $1,800. How crazy is that?
Well, it was overbought on a short-term basis. It's still very, very undervalued and very, very cheap by any kind of historical measure.
Yeah.
And if I were in Bitcoin at the moment, I would be thinking about diversifying some of that Bitcoin and putting it into real wealth, buying gold, buying silver, and buying other things that forms of real wealth. Buy some farmland, buy some other types of real estate if you can generate cash flow from it, like an apartment building or things of that nature, in order to protect what you've accumulated in this run up to $60,000 a coin. Bitcoin might go higher, and if it does, leave some of your position on, but take some profit along the way and put it into something real in order to diversify your wealth.
Oh, James, you're such a boomer. At least that's what they would say on Twitter. It says, "What a boomer."
Actually, though, I like cryptocurrencies for one reason. They are a new technology, and what they are doing is they're educating the millennials that there's something better out there than fiat currency. And cryptocurrencies are a stepping stone to what's really the best money and what has been money for 5,000 years, which is, of course, physical gold and physical silver. So as this stuff plays out, I think you'll see the cryptocurrency people eventually moving into the precious metals. It's just a matter of time. That's the way it's always worked throughout history. Gold always wins, silver always wins. Because they have all of the things that one needs for them to be money. And the most important of which is that they're tangible. You can hold it in your hand and you can take it anywhere you want. You can't do that with cryptocurrencies, which have a lot of other issues related to reliance on the internet, electricity consumption, how you're going to get your hands on it. So the two are actually complementary at this stage while we're fighting fiat currencies. And I really think that the cryptocurrency guys and the gold guys are on the same side. And they are complementary because the advantages of cryptocurrencies are the disadvantages of gold. Gold can be confiscated and has been. Cryptocurrencies based on current technology cannot be confiscated. But the advantages of gold are the disadvantages of cryptocurrencies, that you can hold gold in your hand. You can't do that with a cryptocurrency. So, these two are complementary now. We're fighting the war against fiat currencies, and I think we're really on the same side.
That's a good point. And I see a lot of people like Lawrence Lepard on Twitter making that same argument that, sound money, I mean, I'm not a crypto guy, but there are significant gold bugs on social media who are making that exact same argument that Bitcoin and gold are on the same side. And then you have guys like Peter Schiff on Twitter going to war with, being a Bitcoin troll, just going out there constantly starting, poking, start, trying to make gold and Bitcoin, total enemies. And Michael Saylor and those guys, Max Kaiser, they also, they take a very hostile, we have to kill gold. I mean, we have to demonetize gold type of attitude of we must crush gold and replace gold entirely. Gold is the enemy. I mean, so, there's that battle going on social media to discredit one side or the other.
The enemy is big government, fiat currency. And what we need to do is go back to the provisions of the Constitution, which are very, very clear and worked reasonably well up until 1933, when gold was confiscated in the United States by the autocrat called Franklin Roosevelt, and brought in an entirely different constitutional structure, which changed everything, turned the country upside down. Remember, the Constitution says that the federal government has 17 specific powers. That's it. And one of those powers is to coin money, not print money, to coin money and to regulate the value thereof. And what regulate the value thereof meant is that the government can set the gold-silver ratio between the two types of money that they're coining, so that there was always sufficient metal on hand. And they did that once in 1837. They did it again in 1900. And then in 1933, the Constitution was killed by Roosevelt and his ilk.
Hey, I wanted to bring up another point with you. I know you've commented in the past on Basel III. And, a lot of us last summer, when we felt like, I don't know, I forget, was it June or July? We thought some big deadline was about to happen with Basel III and was going to change the world. And then it didn't happen. And then we were thinking, all right, now I hear people talking about next January 2022 is going to be some major Basel III rule that's going to, 5 or 6 weeks from now, something's going to change because of Basel III rules being implemented somewhere. And then I get this, thing on the Financial Times, FT, where they're saying the UK is pushing back deadlines again on Basel III. So, I mean, is this all just like the Charlie Brown Lucy thing where they'd hold the football and Lucy yanks it away right before, he hits the football? I mean, it's like Basel III never does anything.
Yeah, I've been at this for 50 years, and I've never seen governments or banks do anything to help people. It only helps governments and banks. So I've always been pretty skeptical that Basel III was going to amount to anything. But I would like to say there is one reason why I think it could. Back in the 70s and the 80s, we were in a bipolar world, and everybody kowtowed to the federal government because they wanted protection under the US nuclear umbrella. That no longer applies, and it hasn't applied since the 1990s. So the ace up its sleeve that the federal government had previously, from a geopolitical sense, it doesn't have that any longer. So it is possible that Basel III now could be influenced by the Russians and the Chinese, who want to see gold once again emerge as an international form of currency in order to reduce the US's strategic global advantages of having a currency that's being used for international trade. So it's a question of who really controls, the central bankers in Basel. Are the central banks that are outside the US orbit taking control, or does the Anglo-American alliance still rule the world of finance? And that will play out in the months ahead, but I think that's what we should be watching. So to see whether Basel III or Basel 15 or Basel 69 or whatever eventually has any impact on the gold market.
Yep, it's going to be Basel 69. I have a feeling.
Nice.
But hey, any final words? Gold targets, silver targets for 2022. Can we get you on the record with anything?
Oh yeah, well, I've been on the record so many times. I've been wrong so many times.
Well, what's one more? Come on, what's one more? Come on.
The bottom line is that you continue to accumulate gold, physical gold, continue to accumulate physical silver, and let the market unfold and tell us its story. It'll all happen over time. Patience is hard to accept, but sometimes when it comes to markets, you just have to be very, very patient. And with gold and silver, you can be patient because you're dealing with a 5,000-year track record, as opposed to fiat currency, which has just several decades track record. And we can see the mess that fiat currencies are creating. In terms of targets, silver particularly, we have to get over minor resistance at 26. Once we get over 26, the big resistance is 28. I think you're going to do that by the end of the year, notwithstanding today, just simply because of everything that's coming together. Once you're over 28, then you got to start looking at 50. And then when you're over 50, that's when the bull market begins. 50 was the 1980 high, the 2011 high. This is all accumulation. This is a base of accumulation that we're seeing in silver. It's not a bull market yet. It's still, the accumulation, getting out the weak hands and the strong hands are moving in. That's maybe going to happen.
Guess who agrees with you? Jeffrey Christian.
Oh, really?
This was just on Friday or something like that. He put out his targets, which very similar to what you just said.
Wow. Next 10 trading days. I'm not that bullish, but anything can happen when it comes to gold and silver.
Yeah.
But anyway, those are the levels for silver. The levels for gold, we took out 1835. We came back and we're now testing support below 1835. Let's see how it goes toward the end of the week and the shortened week because of the Thanksgiving holiday. I think we'll be back above 1835 by the end of the week. It would be my guess. And once you're above 1835 again and through 1880, then we've got to start looking back to those record highs, and I think you could see new record highs in gold. End of the year is getting pretty tight now because we only have a few weeks left. But Q1 of 2022, I think that's possible. But regardless, with all of this inflation that's going on, I think 2022 is going to be a great year for the precious metals and the shares of the companies that mine them.
Yep. Any specific mining shares that you're into?
I don't really get into that. That's outside my area.
Okay. No, you just said mining shares, so I thought I'd ask.
Yeah, well, that's for those people. But remember, gold is cash. Gold is money. Mining shares are an investment, and that's an entirely different level of risk. Gold is liquidity, and when you have physical gold, you don't have any counterparty risk. Mining shares, you're dependent on management, the financial statement, the property, the government where the property is located, and all these other things that you have to look at when you're making an investment. So keep in mind that buying a mining share is very, very different than buying physical gold and buying physical silver.
Understood. And on that note, thank you very much for joining us. We really appreciate you sharing your information, your opinions, your wisdom. We'll talk to you next time.
Yeah, thanks. Look forward to it.